We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at Plancorp and the author of Making Money Simple, Peter Lazaroff.
The time for year-end tax and estate planning is now. And this year, it's particularly important because in 2025, a number of provisions from the Tax Cuts and Jobs Act are going to go away. And that is why I've asked my colleague, Susan Jones, to talk about the planning opportunities that deserve your attention before the end of the year. Susan Jones is a senior wealth manager and shareholder at Plancorp, and she has over 20 years of experience serving individuals, families, fiduciaries, and private foundations on all sorts of tax and estate planning topics. Listening to our conversation, you will undoubtedly see that Susan understands the many facets involved and why it is so important to get started now, as opposed to wait until the last moment when some of these provisions are sunsetting. As always, you can find detailed show notes and links to all sorts of important resources at thelongterminvestor.com. And now, here is my conversation with Susan Jones. Susan Jones, thank you so much for joining me here today on the show.
Absolutely. Thank you, Peter, for having me.
Well, I know you're really busy. We are right in the thick of year-end planning, and I think that's maybe a nice jumping off point. Can you share what that typically means for us at Plancorp and our clients?
Sure. Well, the good news, Peter, is that we really consider tax planning to be a year-long endeavor. So some of the hecticness or fire drill nature of year-end planning isn't quite as applicable, but we really want to take this time to, work with clients, review client situation, and just make sure that we're not missing an opportunity. And so on the income tax side, that usually means, are there ways that we can either defer income, accelerate some deductions, or really take into account kind of the marginal tax rate planning to reduce income and income tax, both for this year and going forward. On the estate tax side, we're really looking at, for clients that make annual exclusion gifts, have they made those gifts? If they're not making them, should they be making them? Will they be in a potentially estate tax situation? And then for more complicated planning, a lot of times there's, some dotting of the I's and crossing of the T's that just need to be done before the end of the year. And so we're just really making sure that all of that is completed. What's a little bit different about this year is that we're not only thinking through tax impact for 2023 and maybe 2024, but really taking into account the provisions of the Tax Cuts and Jobs Act that are expected to be repealed at the end of 2025. And just for a little bit of background, the Tax Cuts and Jobs Act, sometimes called the TICJA, which I might refer to it during this presentation, was enacted again at the end of 2017 and was really very sweeping legislation, both in terms of the number of individuals that were impacted, as well as just the kind of dollar impact on those individuals. But many of those provisions were scheduled to end or sunset at the end of 2025. And, I can remember when that became law and thinking that 2025 sounded so far away. And yet here we are, again, going into 2024, and all of a sudden we are kind of right there. And many of these provisions, or just kind of the planning around them, really, in many cases, almost require multi-year planning to really think through those implications. And so this year, just again, knowing how close we're getting, that's something that we're really taking into account as we do that multi-year planning.
Well, I love that you bring that up because a lot of times, and I'll admit, prior to speaking with someone like you who is so knowledgeable about taxes, naturally, I go and Google year-end planning articles, and you really only see that every year, year-end planning articles are only focused on that tax year. So I'm really excited today to be digging into some of those multi-year planning opportunities with you that you really do need to start now in order to capitalize before the sunsetting of these tax provisions in 2025. And I'd like to start our conversation focused on this income tax planning side and then move into the estate planning because there's some implications there too. Even though I'm sure as you're talking, there might be some overlap points, but does that sound good to you?
Yep, that's great. That's perfect.
Okay. So let's start with tax projections, which was something that amazed me when I first came to Plancorp, just how detailed the tax projections we are. And for people who aren't really familiar with tax projections, you are often doing them just to understand what the potential impact from a tax perspective are of different options, just to help you make better decisions. And it's not to say that taxes are the ultimate decider. There can be very good reasons to accept a higher tax bill. if the move provides other benefits. But by running those numbers, we can guide you toward a conclusion with the full understanding of the pros and cons of any financial move. So with all that in mind, Susan, maybe you could just kind of explain, who is a tax projection useful for, and what are the type of information that we're collecting and the sort of items and opportunities we're looking for when doing them?
Sure. Peter, I think just kind of to your point, doing tax projections, or what I often say tax modeling, is so important, just because I think a lot of times when we're talking about taxes and the tax impact of a certain action, it's very, not easy, but I think kind of that knee-jerk reaction is to say, oh, if you do this, then the tax consequence is this. But really, because of kind of all the interrelated calculations and just the nature of taxes, is that until you really put kind of that pen to paper, now, of course, we're not using pen and paper, we're using very sophisticated tax modeling software. But until you really take a look at how kind of the numbers work out and understand why, I think it can be very difficult to make decisions. And so, really, I would say anyone that has either certain aspects of their income or certain deductions that can be controlled really is someone who should be doing that tax modeling or those tax projections. And so what I mean by that, someone who has, maybe they're employed, they have a W-2, they take the standard deduction, they might not be the best candidate or really need to do a tax projection, simply because their income in many cases, it kind of is what it is, and there's not much they can do about it. On the other hand, anyone who has either a business that they have some discretion over when income or expenses can be realized or recognized for income tax purposes, if there's, bonus situations where there's a little bit of ability to shift income, clients who have retirement accounts that can take RMDs and kind of shift or even do conversions, things like that. And one of the things we see most often are clients who are very charitable and that, again, have some discretion with the timing of those contributions that we can really plan around. Also, tax projections, I think sometimes, people hear that word and they're like, oh, that sounds so difficult or so painful. But really, it doesn't have to be. And so when we're doing a tax projection for a client, we always start with the prior year tax return. That's always kind of the best jumping off point. So we're going to, request a copy of that. Usually we already have it on file because, again, we're doing this year round. And then we just roll everything forward and really take a look and say, what has changed and what do we expect to be the same? And that gives us really our base case that we say, this is without any changes. This really is how this year is going to end up. And then we start kind of playing around and we say, but what if we did something different? Maybe we have a client who's in a particularly low bracket this year. What if we added some income? What would that do? And then again, keeping in mind things that could change either because of the client situation or because of tax legislation, we can roll that forward and say, here's what maybe 2023 can look like, but how does that impact 2024, 2025? And we can even go on from there. So it really is, again, one of those things where we kind of take back and say, what's the default? And then how can we improve upon that?
Well, that's such a great explanation. And I think the process is always so informative. And even if you don't take any specific action, at a minimum, you eliminate surprises. And I think one thing that's true for myself, I can say for sure, but anybody else I talk to in April, client or otherwise, is that they're never happy with the surprise. So I do like that element of it as well.
Yeah. Unless it's a good surprise.
You're right. Good surprises we'll always take, of course.
Right. Those aren't the ones you remember, though.
That's probably true. You mentioned some of these in passing, but I'm wondering if you could dive a little deeper into some of the common tax planning strategies that result from these tax projections. And knowing that the Tax Cuts and Jobs Act is going to sunset in 2 years, how that might impact the planning this year for those strategies.
Sure. So, Peter, one of the things that we're always looking for is, again, what tax margin is the client in? And so a lot of times, just kind of a background, I think, most of us know that we're not in a flat tax situation. And so to the extent that you make more income, the higher, kind of echelons of that income are subject to higher rates. And so a lot of times clients are in positions where their income varies from year to year. And that can either be because of, again, a business that has variable income. It can be because of the way their compensation is structured, either by being on commissions, things like equity compensation, but there's just a lot of variation. Sometimes it's clients that are retired and aren't in a position yet where they need to take required minimum distributions from their retirement accounts. And so they just have some income tax years where they're in a much lower bracket than maybe we expect them to be in the future. And so one of the first things we do in a situation like that is say, well, how can we, again, minimize income tax in future years by taking advantage of these lower bracket years right now? And so one of the best ways that we kind of plan around that is looking at those retirement accounts that were funded on a pre-tax basis, meaning that when those distributions are made later, they're going to be subject to tax, and not just subject to any tax, but subject to tax at ordinary income rates, which are the highest rates that you can pay at. And we say, is there a way that we can accelerate that income now? Generally by doing Roth conversions. And so, taking a distribution from an account, recognizing that taxable income right now, but then putting it into a Roth account that then is going to grow and be tax-free when it comes out later. So, that's something that, again, we look at every year, regardless of kind of what year it is. But this year, we're especially paying attention to that because as part of the sunsetting of the TIPJA at the end of 2025, rates, not only will the top rate potentially increase from 37% to 39.6%, but some of those rates more in the middle. One of the things that happened is that although the rates themselves didn't change, the brackets at which they hit expanded. And so for many individuals, they actually were subject to or are subject to a lower bracket than they otherwise would be. And so, traditionally, we're making sure that we're taking in really maximizing the use of the 12% bracket and the 24% bracket. But part of the things we're thinking through now is, even at the 32% bracket, if it's a client that's going to be in a 39.6% bracket later on, do we consider looking at that bracket as well in order to accelerate some income this year? One of the things that's really helping with that as well is the fact that because of changes in the age at which required minimum distributions are required, that we have more clients than ever that have some of those income tax years where they have that discretionary ability to take income from different sources. And so as part of the most recent Secure 2.0, for many individuals, now they're not required to take those required minimum distributions until age 75. And so for clients that retire earlier, that just leaves even more runway in which we can, again, really make sure that we're using those lower income tax years in order to accelerate that income and some income tax, knowing that overall over a multi-year period, they'll end up paying less in tax. Another item that we're always looking at is, again, those charitable contributions. Again, we have many clients who are very generous. And so, our goal, and I think, part of really our job is making sure that we're helping clients fulfill that charitable legacy while also maximizing the income tax benefits from doing so. And so, again, some of those planning ideas that we see every year are considering, taking into account our clients in a high ordinary income tax year that may be accelerating some of those deductions by using a donor advised fund and really being able to make a larger charitable contribution, take advantage of that high income tax rate in a way, though, that still gives them flexibility in order to make those actual charitable distributions later on. Another thing that we're always looking at is that ability to make contributions of long-term appreciated stock to charities and take advantage of the charitable deduction being based on the full fair market value without needing to recognize that gain on that appreciation. And so that's kind of a double whammy in both increasing your charitable deduction and then also without needing to recognize that income. Another opportunity that we're always looking at is the ability to make up to $100,000 of charitable donations directly from a retirement account to a charity. And that distribution, as long as it's made directly from the retirement account to the charity, does not count as income for the year. Now, there is no also additional charitable deduction, but really the benefit of that is that it can keep taxable income lower and reduce taxes, including the net investment income tax on that income. One of the things I think that's important to point out is that even though there's been that increase in the age at which an individual needs to start taking those required minimum distributions, they can actually start doing those charitable rollovers still at age 70 and a half. And so even if, it used to be that number was really tied to the age at which those RMDs started, but there has, even though that age has gone up to 72 and then 75, individuals still can do that qualified charitable distribution at age 70 and a half. One of the other things, that's really important again for those clients that are particularly generous is that as part of the TICJA, the limitation on gifts to charity of cash was increased from 50% of the overall adjusted gross income to 60% of adjusted gross income. And, again, for clients that are very generous that would find themselves kind of running up against that limit, that really has given that additional ability to make gifts. But that is one of the provisions that's scheduled to end at the end of 2025. And so we're looking, again, for those clients, really making sure that we're taking full advantage of that full 60% limitation in these years remaining up until the end of 2025.
Well, so much really, really good stuff in there. And for everyone listening, as always, you can go to thelongterminvestor.com for show notes with a lot of details on all these different items. And, as we talk through some of the tax strategies that are going into consideration that help us either accelerate income, defer income with Roth conversions and charitable gifts, one thing I think it's worth pointing out is that the sweet spot for a lot of this happens, these strategies that you've been talking about, Susan, when you're retired and your income's down and you haven't been required to take money out of your IRAs yet. I'm kind of curious, can you share any examples for people who are in their working years that might also be looking at some of these strategies? So it's really easy for me to picture the retiree. What about the person who's high earning, maybe even has some stock options?
Right. Well, and so Peter, there's a couple things with that. So I've been talking a lot about making sure that we take advantage of those lower income tax brackets to accelerate income. But just as importantly is understanding that deductions are worth more when they're offset against income being taxed at a high rate. And so a lot of times, again, that charitable planning as we're leading up to retirement, that a lot of times is a time to really maximize your charitable contributions. And a lot of times we see that within, kind of the last 2, 3, 4 years leading up to retirement is when a lot of individuals have some of their highest ordinary income tax years. So that can be a great opportunity to, again, set up a donor advised fund, really pre-fund a lot of those charitable contributions for retirement and take advantage of the deduction value at the highest rate. One of the other things that we're always looking at is both the income, regular income, and the alternative minimum tax for clients who have equity compensation. And so, first of all, I hope I didn't scare off any viewers by just even mentioning alternative minimum tax. A lot of times AMT could be kind of a trigger for many of us. But, that really is something, and again, for those individuals that have equity compensation packages, is always kind of a key consideration when we're putting together equity compensation strategies. Of course, it's not the only consideration. And so you had mentioned, early on, Peter, just the importance of not letting tax completely drive a decision. And that's certainly a good example. But one of the things, just kind of delving into that a little bit more. So just at a very high level, the AMT is an alternative tax system. And so you have kind of your regular tax. So if you think of it as a ledger where we calculate your income and then your deductions, and then you arrive at your taxable income, the AMT is kind of a similar, kind of that same process, except that there are some both income and deduction items that are either disallowed or added back for AMT purposes. And then you kind of take a look and see what your regular taxable income is, your regular AMT, calculate the tax, and then you pay the higher amount. And one of the most common items that's adjusted is actually the exercise of incentive stock options. And so for regular income tax, that's not an event. And so if you exercise your ISOs, there is no regular tax consequence. On the other hand, for AMT, the difference between your exercise price and the fair market value actually is taxable income. And so when we think, again, kind of our alternate systems, in those years, oftentimes you're going to have a higher AMT tax liability and then end up paying that AMT. Now, it's not quite as draconian as it sounds. You do then have a higher AMT tax basis in those shares. And so later on, it often kind of reverses itself. But still, that's, can be kind of a terrible surprise for individuals who weren't expecting that, and often is something that we can plan around. Again, one of the items in the TICJA that changed was the AMT exemption both increased, but then also the income threshold for when the AMT exemption goes away was really significantly increased. And so the result of that is that for many individuals who previously would have been subject to the AMT, they're not subject to the AMT right now. And so, again, that's something that as we're looking through and thinking through some of these equity compensation strategies, we're really taking into account that the AMT burden right now might actually be less than it would be in 2026 and moving forward.
Yeah, that's a really good example of something that at least I've sat in on some conversations where if you're in your high earning years and you have those equity options and you've been earning them for a long time and think that you have your tax picture set correctly in your head, there's a really strong chance that you don't. So this is one of those great times. The time is to act now for that multi-year planning. So I love that you bring that up. And then I know there was a tax deduction for business owners as part of the Tax Cuts and Jobs Act. Can you talk a little bit about what needs to be considered with that right now?
Sure. So, Peter, this is a completely new provision, and for many business owners, really provided a great tax benefit. It's called the Qualified Business Income Deduction, and it can provide up to 20% of a deduction off of business income for certain owners of pass-through entities. And so that can either be a sole proprietorship, it can be an LLC with only one member that's a disregarded entity, it can be an owner of a partnership or an S corporation. So anytime there's that flow-through income. We could, easily spend a couple of podcasts talking about all the intricacies of that provision. But again, at a very high level, some of that benefit can go away at different income levels. And so a couple of things that we're really planning around when it comes to that deduction is first keeping in mind that it is scheduled to also sunset at the end of 2025. And, that's something, again, for those who are eligible, could really have a pretty significant tax impact. And so in those cases, we're looking at, again, does it make sense to try to accelerate income into these last, few years, knowing that we have that deduction to try to get that 20% essentially off of the income tax. Now, what's a little bit tricky about that is that, again, one of the limitations on that is an income limitation for certain types of businesses and for certain businesses that don't have additional employees. And again, there's a lot of intricacies in there. But one of the things that we're really keeping in mind is that there is an income limitation on that for certain types of businesses and for certain businesses that don't have additional employees. And so it can be very punitive if you actually accelerate too much income and get over those thresholds and really essentially result in not having any of the deduction. And so that's another great example of where, again, putting that pen to paper, doing that tax modeling is really important, as opposed to just thinking, I'm going to try to accelerate as much as possible, and then end up not being able to have additional amounts, but potentially even lose that 20% discount as it is.
So shameless plug here. You've heard all the ways. If you're a retiree, if you have ISOs, if you're a business owner and you aren't doing proactive tax planning, the time is now. Again, go to thelongterminvestor.com. You can schedule a call. You can meet people like Susan, who I don't mind saying knows way more about this stuff than I do. That's why she's here to help us. And that's why I'm going to ask you, Susan, before we transition into estate planning, is there anything about income tax planning that you feel we've missed that you feel like deserves some mention?
Yeah, Peter, I'm just going to expand a little bit on something that you said at the very beginning, which is about surprises and just, if nothing else, knowing what you're going to owe and, that following April. And one of the things I think that can be easily missed and that we're, again, always looking for when we're doing tax projections is there a possibility, that someone's going to have a significant tax bill due, and what can we do about that in terms of cash flow planning? But also, is there a potential that there could be penalties owed? And so individuals, really the rule is at the federal level that you have to pay in at least either 100% or 110% based on your prior year return, or 90% of your current year tax. And it's actually the lesser of those two. And so really making sure that, A, you're not overpaying too much, taking into account those rules, but also that you're paying in enough to avoid those penalties, because that can be, again, not necessarily always a big dollar amount, but year after year can certainly add up. And so just wanted to mention that because, again, that can be sometimes, not as complex as some of the other tax planning that we're doing, but also very important.
I have a friend who always says that it's important to pay your tax bill to the IRS, but you don't need to leave them a tip. And a lot of what we're talking about is, we pay our fair share, but there are ways to make sure that your fair share is, taking advantage of all the rules that are there for a reason. So appreciate you saying all those things and sharing all that, Susan. Let's go ahead and dive into estate planning now. What do you think it is that people need to know about the current estate tax laws? And what are some ideas that you think people ought to be considering right now?
Sure. So, Peter, I think one of the things that's always kind of top of mind and important to know is what are those kind of important numbers on the estate tax side? And so in 2023, each individual can make up to $17,000 of annual exclusion gifts. So they can make gifts directly to, any individual for that amount. Their spouse can as well. And so, combined, a married couple can gift up to $34,000 without using any of their estate tax exemption, or even in most cases needing to file a gift tax return. Also, the exclusion, so the amount that you can pass to loved ones, family members, et cetera, without the imposition of estate tax is $12.92 million per individual. And so, certainly at that level, there are many individuals subject to estate tax. So one of the things, though, that we're really keeping in mind as we approach the end of 2023 is that $12.92 million will decrease if the sunset provisions of the TICJA go forward. And so that was something that was expanded as part of that legislation in 2018. And so right now, under that law, without any changes, it's scheduled to actually decrease back to the original $5 million plus inflation. And so we're expecting that to be somewhere in the $6.5 to $7 million range. Certainly still a large number per individual, but really, when we consider many clients that are young, that have accumulated significant assets in retirement accounts and their home equity, et cetera, there are many, many more individuals who would be subject to estate tax at that level. And so really, thinking through and understanding the impact of that decrease is something that we're looking at. Every year, again, we're taking into account making sure that clients are making those annual exclusion gifts, but then also, again, particularly knowing what could happen to the estate tax exemption, considering other, alternative estate planning strategies as well. And one of the estate planning strategies that we've helped a number of clients implement is the creation of spousal limited access trusts, otherwise known as SLATs. And those are trusts, they have a great name, but really they're just irrevocable trusts where your spouse is named as a permissible beneficiary, meaning that they can receive funds from the trust. And the reason that those trusts work so well in this situation for many couples is because even though spouses can create these gifts for each other, it essentially gives that grantor who's creating the trust indirect access to the trust assets. And so should those funds be needed for lifestyle expenses, for some type of emergency or something that wasn't anticipated, there is still the ability to, kind of take funds out of that trust, which isn't available if your spouse isn't a beneficiary. And so that's something that has, again, really been successful in many cases. One of the things that has, made that particularly top of mind is that in order for those trusts to be fully respected, they need to not mirror each other and have different sets of provisions in many cases, and oftentimes even be established in different tax years. And so when we think through that, again, knowing that we're getting to the end of 2023 into 2024, the time for, having all of those options available really is starting to become very limited.
Well, that's really interesting. I mean, I've always known that just in general, complex estate planning strategies can take multiple years to implement. If your deadline's December 31st, 2025, especially for those who have an estate tax liability or will when the exemption goes down, this is definitely the time to get to it. It does seem also at this time of year for those who don't have estate tax liability, but still feel like they're trying to help other generations and make gifts to their kids or grandkids, that those are still all pretty common conversations that will be had, plus beyond the sunsetting. But what are some of those kind of regular year-to-year conversations that we have with clients?
Yeah. So, again, Peter, just really thinking through the annual exclusions, making sure that those are being maximized. Every once in a while, I'm talking to someone or a prospect to someone I meet at a party, and they're telling me that they're working on a very complicated estate strategy. But then when I ask about annual exclusion gifts, it turns out that they're not really maximizing that. So I always think, do the low-hanging fruit first and really make sure that you're doing that to the full extent. Another one that we're always thinking of, but that often gets missed, is the ability to make gifts of tuition directly to a university or other school and have that really not counted at all for gift or estate tax purposes. And so, again, we have a lot of clients who really want to make sure that their family members have the opportunity of education. And so knowing that they can gift as much tuition as they want and have that not count against either the annual exclusion or that lifetime exemption can be pretty powerful and also have a lot of non-tax implications as well.
Well, Susan, this has been wildly helpful. And again, for everybody listening, we'll have really detailed notes as well as a way to get in touch with Susan at the show notes at thelongterminvestor.com. Susan Jones, thank you so much for your time today.
Well, thank you, Peter.
To everybody listening, please be sure to like, subscribe, leave reviews, do all the things that help other people find the show. We really appreciate the feedback. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of Plancorp and Brightplan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of Plancorp or Brightplan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Plancorp and Brightplan may maintain positions in the securities discussed in this podcast.